A little over 2 months ago, I started selling stock options. Now, my goal was to make just 0.5% per week in returns. Instead, I ended up making over 4 times that amount and over $2,000 in returns. So, how did I get here? How risky is this? And will I keep using this strategy? But first, what even are stock options? Well, the very basic definition of stock options is that they are a type of financial contract that gives someone the right to buy or sell a specific amount of a stock at a predetermined price within a certain time frame, offering the potential for profit if the stock price moves in their favor. There are two main types of stock options that most people trade: cash secured puts and covered calls. Now, I can feel your eyes glazing over, so let me show you some of my results before I explain the difference between those two different types of stock options. So how has the past 2 months of stock options trading been for me so far? I started selling stock options at the end of March. When you sell stock options, the returns can be great, but they are way lower than buying stock options. However, when you sell, the risk is way lower. So that's the strategy I ended up going with, and I will explain more on the risk in just a bit. I started with $2,000 in my Robinhood account, as all noob traders do. However, in the past 2 months, I've added more capital. I've added about $18,000 in total so far. I did that because I wanted to start small and then learn the ropes and then scale in more over time. And actually, I started scaling in a little bit faster than planned, but you can start with those smaller amounts. In March, I earned $209 in premiums, which is just the fancy word for the reward you get when you trade stock options. This is premium. In April, I earned $1,039, and so far in May, I have earned $1,017, and we have well over a week left of the month, which brings my grand total to $2,265 so far from selling stock options, which is a return of over 6% per month. And annualized, that would be 72% a year in returns. Now, I'm not expecting that. I expect to have some months that are only 1 to 2% or maybe even a bit lower, and some months that are higher than 5%. But it's still super cool to see what could happen if things keep going this way. Okay, back to those two types of options that I have been selling: cash secured puts and covered calls. I'll explain both, but just know that you can both buy and sell those types of options. And often when stock options are brought up or mentioned, people will inevitably talk about how super risky they are and how you can lose all your money easily and how your wife will leave you and how you will spend all day long down in the basement staring at charts and never talk to your kids anymore or even see the sun. And all of that is definitely, probably, maybe true if you are buying stock options. The only thing I'm doing though is selling options. While not risk-free, it is way less risky than buying options. When you buy options, you are the gambler in the casino, plunking those coins into the slot machine. But when you sell stock options, you are the casino, and you are Robert De Niro. Much cooler. Now, the gambler could win crazy high returns, but they could also lose all their money, lose their shirt, and get their head put in a vice. When you sell stock options, though, when you are the casino, you can still make lucrative returns, but with way less risk. Now, the returns aren't as high as buying options, but still really great, at least in my opinion. I'm gonna tell you exactly what cash secured puts and covered calls are, and I'm gonna do all that as effectively and simply as I can, but it will be a little bit technical. So if you just want to skip to what the risks of all this are and how to actually get started and skip over the technical definitions, then jump to this time in the video. And now that the posers are out of the room, let's get into the good stuff, my galaxy brain friends. So what does it mean to sell a cash secured put? Selling a cash secured put is basically like making a promise to buy a specific stock in the future, but only if the price is low enough. Since you're making this promise or contract in the future, you get a little cash reward for doing it, and this is called a premium. To make sure you can keep that promise, you need to have enough money saved up to pay for the stocks if you do have to buy them. If the price stays high, then you don't have to buy anything and you get to keep the money you receive from making the promise. So let's say I wanted to sell a cash secured put of Marathon Digital stock MARA. I would need enough money in my account to buy 100 shares of MARA, at that future contract price, which is called the strike price. If I sold an option saying that in a week, if MARA is $8, I will buy 100 shares of it. If it's higher than that, then the contract expires and I don't buy anything. For doing this, I get paid a little premium, and let's just say that's $10. So to do this trade, I need $800 in my account. If at the end of that week, MARA is at $8 or less, my $800 I use for this is converted into 100 shares of MARA. If the stock price is higher than $8, then I get my $800 back. In either case, I get to keep that $10 premium for making the trade. So that's cash secured puts then. What about selling covered calls? Selling a covered call is like renting out something that you own, such as your car, to someone else for a little while. In this case, you're renting out your stock to someone who wants to buy them at a specific price. If the price stays the same or goes down, you get to keep the stocks and the rent money. But if the price goes up, you have to sell the stocks to that person who rented them, but you still get to keep that rent money. So let's say I have 100 shares of Coinbase stock, which as of right now is worth $60 per share. I decide to sell a covered call on these shares. I sell the option for someone to buy my shares at $68 1 week from now. In return for this contract, I get a premium of $50. If in 1 week's time, the price of the stock is less than $68, I keep all my shares. If the price is $68 or higher, then I sell all those shares at the $68 per share price, which is my strike price in the contract. Either way though, I keep the $50 premium I earned for the trade. So the big question is, how risky is this? What's the worst that could happen? When you're selling a cash secured put, the worst that could happen is that you end up buying the shares and then the stock goes to zero and you lose all your money, which is no different than buying and holding a stock. It doesn't matter if you just buy Tesla stock and it goes to zero, or if you sell a cash secured put, end up receiving that stock and then it goes to zero. Both are bad situations, and it's also extremely unlikely, but it technically could happen, so it is worth thinking about. But this is also a huge reason why I only do this on stocks that I think are not going to zero, aka not super high crazy risk stocks. Like, I'm not investing in First Republic Bank because that stock was $122 just 2 months ago, and now 39 cents, down 99.68%. Yikes. The other risk is that you buy the shares and the stock continues to drop in price. It doesn't go to zero or anything, but it drops 5, 10, or more %. Some would see this as a risk, but that's okay for me because I'm only selling options on stocks I actually want to own and at prices I am okay owning them. Plus, this can work in your favor too, because you can now sell covered calls on your shares that you just bought. People call this the wheel strategy. So what's the worst that could happen with selling covered calls? Well, if you get to the end of the week and the stock price is higher than what your contract is for, then you will end up selling those shares. You get the cash in return, so there is no risk of losing that money in that case. However, if that stock continues to climb up and up, well, you don't own those shares anymore, so you'll miss out on that appreciation, which in my case, I also don't really care about because I'm focused on the weekly earnings from selling the options more than the long-term buy and hold of these stocks. So, can anyone do this? Well, yep. As long as you have an account at a stock brokerage that supports options trading. I, again, use Robinhood, but there are so many others. You can also even do this in other countries, like quite a few people in European countries use the brokerage Interactive Brokers, for example. So aside from needing a brokerage account, you will also need, surprise, surprise, money. The great news though is that you can get started with as little as $500 or maybe even less depending on the stock you end up selling options on. But most people I chat with start with about $1,000 and work their way up from there. As far as difficulty, that just comes down to you and where you learn from. If you're willing to put in the work and you have a good place to learn about options, then anyone can do it. And if you do want to learn stock options, then you should join my community, Sleep Money Club. Included in our VIP membership, aside from being a very important person, you also get 2 stock options courses that will teach you everything you need to know about getting started, and you will also get access to the stock options chat where you can ask questions and learn directly from our experts and teachers. Most people who join and start with stock options pay for their monthly membership in the very first month, but we also offer a 7-day free trial to just check it out and see if it's a good fit for you at zero risk. People like to say stock options are passive income. So is selling stock options really passive income? Well, yes and no. I'd call it semi-passive or maybe mostly passive. I sell my shares once a week, and then the rest of the week is pretty much hands off. I might only spend, 30 minutes or an hour each week on my stock options. Now, if it's a crazy week or if there's some specific opportunities that do come up, then you could end up spending a bit more time. But overall, the time commitment week to week is very low once you've learned the ins and outs of stock options. But how does this compare to just investing, buying, and holding? Well, I think this is a great strategy to do alongside buying and holding. A lot of people use a percentage of their returns from selling stock options to buy stocks in their portfolio to just hold for the long term. But the biggest difference is that when you just buy and hold, you don't do anything. You just buy and hope the stock appreciates in the future. With stock options, it's a lot more active, and as a result, the returns can be higher. Like I said before, selling stock options like covered calls basically carries the same risk as just buying and holding a stock, but you get to earn a little income while you hold when you sell the options. So for me, that's a very worthwhile prospect and why I've adopted this strategy. Speaking of great strategies, you should really watch this video where I talk about how you can earn $5,000 or more by spending just an hour or two of your time, even if you are a total beginner to the strategy. It's almost all upside. So go make that money, and I will see you in the next one. Goodbye